Welcome back, everybody. The inflation numbers for March were released last week, and they were higher than expected. And people are assuming that Fed cuts will either be delayed or not happen at all now. And I've talked about that as an investor, I don't really focus on rate cuts all that much. I still just want to buy quality companies that I want to hold no matter what's going on at a macro perspective. But I do think it's important that we have an idea of what's going on in the economy and how it may impact our actual lives. And there are three things that I saw that tell me that it might actually be worse than many people are thinking. So in this video, we're going to talk about what those three signs are, discuss what it might mean for stocks, and finally, what we can and should be doing about it. So let's get started. Sign number one, inflation is likely worse than the numbers. Now, everyone's focused on the fact that CPI, or the Consumer Price Index, rose 3.5% from a year ago, which was higher than 3.4% expectations, which then pushed the expectation of the Fed rate cuts back to possibly September instead of June. But what does that actually mean? So let's first talk about what CPI even is. The Consumer Price Index measures the overall change in consumer prices based on a representative basket of goods and services over time. But the key part to that is a representative basket of goods and services, because what are those? Well, here's the breakdown. You have 13.7% of the index made up of food, which includes food at home and food away from home. 6.6% of the index is made up of energy, which includes gasoline, fuel oil, electricity, and utility gas service. And then 79.7% is made up of everything else. And this everything else outside of food and energy is what they call core CPI. But what are all those things? Well, they categorize them into 7 subcategories that include new vehicles, used cars and trucks, apparel, medical care commodities, which includes things like prescription drugs and medical equipment like bandages and wheelchairs, shelter, which includes rent, owner's equivalent rent and insurance, but it's renter's insurance, not homeowners, which we're going to talk about here in a minute. And then also the cost of hotels and motels. And then transportation services, which include things like airline fares and public transit, as well as the cost of insuring and maintaining a vehicle. And then medical care services, which includes things like medical, dental, and vision care, hospital and nursing home services, and health insurance. Phew, so that's a lot, but at least we have a better understanding of what is being counted in that number. And if we go back and look at the most recent data, we see that for March, overall it rose 0.4% from the previous month and 3.5% over the previous year. Now, estimates were for 0.3% for the previous month and 3.4% for the previous year, so it was close, but still slightly higher. So then why am I saying that inflation is likely worse than these numbers? Well, first of all, your personal experience with inflation can be very different than these aggregated numbers. Because while food may be up 0.1% in aggregate in all areas, where you live may be higher, which again might be true no matter what. But the main reason is because there's one important cost that doesn't actually show up in these inflation numbers, and that's homeowners insurance. If we look at the shelter category, it says owner's equivalent rent and insurance, but that's actually renters, not homeowners insurance. And in general, insurance rates, both for home and auto, are going up a lot. Because even in my personal experience, my auto insurance went up 27% over the past year, and my homeowner's insurance went up over 30%. I mean, seriously. And Bloomberg actually did an article about this, showing how renters' insurance rates are growing, but at a slower pace than homeowners' insurance rates. And if homeowners' insurance was actually included in CPI, it would have increased the index by around 0.8% by itself, according to their calculations. And part of the challenge with rising insurance rates is you don't have much of a choice of not paying it. Like, you can maybe reduce your coverage to reduce your premiums, but then you're also putting yourself at greater financial risk. So while CPI may have only been slightly higher, the reality of our expenses going up is likely much greater. Okay, sign number 2, credit card delinquencies are rising. Now, the Philadelphia Fed released their Q4 2023 Insights report last week, and it showed that credit card delinquencies have been rising and are now at the highest levels that we've seen since about 2011. And just for clarity, credit card delinquencies are when a customer is 30, 60, or 90 days past due on their payment, so it's normally used as an indicator of overall financial health of consumers. And if you watch any of my Amex videos, I frequently look at their delinquency and charge-off rates compared to their peers because, as you can see, Amex tends to have some of the lowest numbers in the industry, which in general means that they have a higher quality customer base in terms of financial health than some of the other credit card issuers. So why this might be a sign that the economy is worse than we think is simply that people have been buying on credit, and now the number of people who can't pay their bills is rising. So people are struggling with having enough money to deal with their expenses and keeping their bills current. Now, obviously, if this trend continues, then not only is it going to be bad for those people who are struggling to make ends meet, but it also means that credit card issuing companies are going to take higher than normal losses in their portfolios. And that's why sometimes you'll see them plan ahead for that with what they call loss provisions. Amex talks about it in every quarterly earnings report, and even during the pandemic, you had banks like JPM, which were ramping up provisions like crazy in anticipation for higher losses. And ultimately, those things come back to hurt even more consumers in the end, because rates will go up due to the default risk rising, or it gets harder and harder to actually get access to credit because the requirements get raised again because of risk factors, and the cycle continues over and over again. And it's one of those things that when you're struggling with money and you get in that cycle, it is very difficult to get out of. Okay, now the last one, sign number 3. People are tapping into their 401ks in higher numbers. Now, the Wall Street Journal had this article about how more Americans are taking from their 401ks as savings to pay for financial emergencies. Because Vanguard Group said 3.6% of their plan participants took early withdrawals last year, which was up from 2.8% the year before and much higher than the pre-pandemic level of 2%. And the numbers from 2022 and now 2023 were back-to-back record highs. Now, Vanguard only administers 401k accounts for roughly 5 million people or so it's a relatively small percentage of total adults in the US, but it's still a pretty decent sample size to go from. And I think one of the more interesting parts of the report was the more detailed stats that they gave at the end, saying 40% took the hardship withdrawal to prevent foreclosure, which was up from 36% in 2022. And that more than 75% of the hardship distributions totaled $5,000 or less. Now, this could mean several different things. It could just be people with smaller accounts that have less elective deferrals that are eligible to actually withdraw. So those would most likely be people who in general would be struggling more financially than others. Or it could just mean that you have people taking relatively small amounts to hold them over for a while because they're looking at their 401k as a slightly more complicated savings account that they can just kind of tap into whenever they need it. Now, of course, neither one of those options is ideal, but I have to say from personal experience, I kind of understand where they're coming from. I've told you guys my story about how I was laid off from my first job. I had no savings, I had no investments, and I met my wife while I was on unemployment. And at one point, we were struggling pretty bad financially, and her car broke down, and we needed to get her a new one. But the problem was, I had no money, I couldn't get a loan, and we had to really just do whatever we could. So I had an old retirement account from my first job that had a few $1,000s in it, and I cashed it out so that we could buy a 2001 Mitsubishi Galant. And let me tell you, that car was a piece of crap. Like, not a great investment, but still probably better than a target date retirement fund. I'm kidding. But the reality is, that's just where we were in life. And people always talk about optimizing your finances and never take a loan from your 401k and never do this or that. The point is, for a lot of people, you do what you have to do in the moment because you don't have another choice. Ideally, you can get to the point to where you have choices and then you can optimize. But I know what it's like to not be there yet, and we just had to do what we did to get by. So I get it. Okay, so all this information is fine, but what should we actually do about any of this? Now, from an investor standpoint, it's probably more about just being aware of it. I don't know that it changes anything that you're doing if you have a long time horizon. Ultimately, you're still wanting to buy quality companies or specific ETF combinations that hit your allocation targets and sectors. Now, knowing that credit card issuers and banks may have higher than normal losses, and know that consumer discretionary companies may take a hit if people start spending less. But ultimately, I don't know that you change whatever your strategy or process is because of this. And a great example of this for me is I just bought Lululemon. Like, they're a high-end consumer discretionary company, so there's a chance that they may be negatively impacted if consumers stop spending. But that's okay for me. I have a long-term view for Lulu, and I think over time, they're going to do well, even if consumers may struggle in the short term. But honestly, I think the real key takeaway here is how we approach these issues outside of just investing. And to me, this is what I think is most important. 1, solidify your income. So basically, if you have a good job, keep it. Companies are going to do layoffs. There's going to be a lot of competition out there for the same job. So if you're in a good job, even if you're a little frustrated or annoyed with it, keep that steady income coming in. And then Number 2, diversify your income if you can. And this is just good advice in general, not just for now, but know what you'll do in the case if you do lose your job. Plan ahead now before you actually need it. And if there's ways that you can bring in additional income outside of your primary income, whether that's dividend stocks or dividend income in general, a side hustle or business, or even a side job. Start finding ways to add additional income streams that can help protect you in case something happens to your primary income stream. And then number 3, reduce your debt obligations. Pay off that debt if you can. So if you have good income coming in now, reduce your outstanding debt so that if and when the time comes to where you lose your job or lose some income, you have less overall expenses that you'll need to cover for. And then lastly, number 4, use as much income as you can to fight the effects of inflation. So any cash or emergency funds should be earning at least 4 to 5% either in a high yield savings account or a brokerage account with a short-term treasury fund, or even a bank CD if you prefer that. And I just did a video about this specifically to show you what I'm doing with my own cash, but the bottom line is take advantage of the higher rates while you can and make sure any amount of cash you have is at least earning 4 to 5% with virtually no risk. And then lastly, with whatever excess you have, investing your money. At the end of the day, that's the whole reason why we invest, to combat the effects of inflation and an increase in money supply, so that we don't fall behind financially and we can live the type of life that we want. But just make sure you take care of the basic blocking and tackling first. Secure your income, reduce your debts, and just be in as strong as financial position as you can possibly be so that you're ready no matter what happens with the economy. So how do you all think the economy is actually doing? Better, worse, or it doesn't really matter? Now, if you want to see a comparison of savings accounts, money market funds, and CDs and where I'm parking my cash, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see y'all on the next one. Peace.